Listen, right now it seems like everybody online is touting SCHD as one of the best investments that you can add to your portfolio. And I got to be honest with you, I have been investing in SCHD for a while, and I put out a couple videos on it more recently. Now, the more I look into SCHD, the more concerning it gets to me. In 2023, the S&P 500 soared over 26%. SCHD, it was limited to just 4%. I was told that SCHD is safe, stable, the perfect dividend ETF. But when I actually dug into what it holds, I found some cracks. And there's sector risk, missed growth, there's yield traps. So this isn't necessarily a takedown, it's more of a reality check for SCHD, because if it is your entire strategy, then you might be playing the game wrong. Now, don't get me wrong, I'm still investing in SCHD, but I want to highlight some of the stuff that I've found. Now, before you get into this video, I want you to leave a comment down below. What do you think about SCHD before you get into it? Do you think it's a solid investment? Is it part of your plan? Leave a comment down below. I'm really interested. But let's get to it. Now, if it is completely new to you, SCHD stands for the Schwab U.S. Dividend Equity ETF. It launched in late 2011, and it quickly became one of the most popular dividend ETFs in the game. Why? Because it screens for companies that have paid dividends for at least 10 years. It generates positive cash flow, and it scores well on fundamentals like return on equity and dividend growth. Now, it also caps each stock at 4%, so no single company is going to dominate the fund. It's cheap. The expense ratio is just 0.06%, and it pays dividend yield around 3.5% to 4%. And it pays quarterly. So it sounds perfect, right? First, let's make the case for SCHD. What it gives you is exposure to well-known companies with strong balance sheets and reliable income. We're talking about things like PepsiCo, Cisco, Amgen, and since its inception since 2011, SCHD, well, it's returned about 11.4% annually. That's including dividends. Not bad at all, especially when you compare to traditional income investments. It's also less volatile than the overall stock market, which is why retirees and conservative investors love it so much. It's one of the main reasons why I love the investment. And it's not just hype, right? A lot of smart investors genuinely believe in SCHD as the ultimate set it and forget it strategy. But when you zoom out, things start to look a little bit different. So despite the praise, SCHD has actually underperformed the S&P 500 over the last decade. Now, let me break that down for you. SCHD's 10-year annualized return, it's around 10.5%. The S&P 500 via SPY is closer to 12.5% to 13%. Now, that gap, though it might not sound huge, over 20 to 30 years, it's the difference between hundreds of thousands of dollars. So if you're investing for long-term growth, not just income, you need to ask yourself, is SCHD enough? And that brings us to 2023. You see, in 2023, SCHD, well, it got exposed. The S&P 500 had a monstrous year. We're talking about up over 26%, driven by massive growth in the tech industry. Now, SCHD, just 4.55%. Yeah, it's not negative, but it's barely a blip compared to what happened to the broader market. Why? Well, because SCHD mostly missed tech, and it just kind of makes sense. When it comes to tech companies, think Nvidia, Amazon, Google, usually they have a solid use for the funds. They don't look to pay out their shareholders. What they want to do is reinvest those funds into tech to grow the companies. And for that reason, a lot of these companies don't qualify to be in an ETF like SCHD. So when tech rallied, SCHD just sat on the bench. And this I really can't highlight enough because SCHD is so underweighted in tech that it really shows. You see, as of 2025, tech makes up less than 11% of the fund. And if you compare that to SPY, tech is well over 34%, and it drives a majority of the returns. So if you're holding on to SCHD as your core position, well, you're betting against one of the most dominant sectors in the market. And that's fine if your goal is just going to be income. But if you're looking for capital appreciation too, you're definitely missing out. And on top of that, it might not be as diversified as you think that it is, because SCHD is 100% US based. There's no foreign stocks within it, no global growth, and that means no exposure to companies like Nestle, Samsung, or Toyota, all of which pay really reliable dividends and dominate their industries. But if the US economy then hits a wall, well, SCHD has no safety net. And if I'm being honest with you, the US right now is in a really interesting time period. So while it feels diversified, it actually bets on just one country and mostly one type of company. And here's a really big one. Let's be honest. Everybody talks about dividend yield traps. I don't know what I'm doing with my arm here, but the 3.5 to 4% dividend yield is what gets people really, really excited for this. But I don't want you to confuse yield with performance, because we all know that sometimes a company boosts its dividend to distract the fact that the growth has stalled. And SCHD unfortunately can overweight some of those companies, you know, the high yield, low growth names that look great on a dividend tracker, but they actually underperform in the long run. Meanwhile, you got companies like Apple or Google, which are growing rapidly and aren't in the fund at all. You're trading long-term wealth for short-term income. Now let's talk about everybody's favorite subject when it comes to SCHD, which is taxes. Now, if you're holding SCHD in a taxable account, those quarterly dividends are, you guessed it, taxed, even if you reinvest them. That can quietly eat at the returns of the investment. And it's like when you get a $10,000 bonus, looks great up front, but then you realize you're paying like 4,000 of that back in taxes, and it just sucks. And that's why I personally hold SCHD inside of my Roth IRA, where dividends are going to grow completely tax-free. So what exactly am I doing now? Well, let's pop open my Roth IRA so I can show you. So you can see this is my $33,000 Roth IRA, and within here I hold just two investments. I own SCHD and VTI. It is the best of both worlds in my opinion. I love dividend investing. It's always been something that I've resonated towards as a investor. It just makes a lot of sense to me. I love seeing the income rolling in, and I love to be able to reinvest any of those dividend payments that are made. But as I've kind of looked into it more and more, with the growth stuff factored in and everything that I outlined in this video, I've also wanted to be a little bit more diversified. So if you look at over the past year, where a fund like SCHD has gone up just 1.75%, I have been investing in this every single day, and I still am. I always max out my Roth IRA. I'm about 50% SCHD, 50% VTI. But you can see this doesn't factor in things like the dividend payments that roll in, which I believe right now, if I scroll into the history and I sort this by dividends, you can see it's about $120 every quarter right now for me. Plus it's going to continue increasing as I invest. It's nice, but this isn't the only way that I invest. You see, I have exposure into the overall market. I've got VTI here, and you can tell just by looking at the return over the past year, this one's up 17.22%. Now, if I was fully overweighted in SCHD, I would not be getting nearly the return that I should be in a portfolio. And on top of that, I don't invest in SCHD in things like a taxable account. So this is my investing account right now that I have in Robinhood, about $34,000 in this one, not investing in SCHD here. And that's basically where my biggest holding for it is going to be within my Roth IRA. I've also created a new growth portfolio you can check out over on the Moomoo investing application. Right now, you could sign up for them. You're going to get yourself up to 60 free shares. I made a video on that. Pretty cool right there. And so here's the deal. SCHD, it's not a bad ETF. In fact, it's one of the better ones out there for dividend investors. But the idea that it's perfect, that it should be as hyped up as it is, that it's all you need in a portfolio, that's just simply not true. It has real weaknesses: lack of tech, limited growth, no international exposure, sector concentration, and tax inefficiency in the wrong account. So if you're going to own SCHD, know what it is, and more importantly, know what it is not. Now, if you guys want to see how I would go about investing if I started over from scratch, go ahead and check out this video right here. If you made it this far, leave a like, really helps with the algorithm. Thank you for checking out this video. Leave your thoughts down below, and have a great day. Hairline's receding, Jesus.